Uh, you can call me, by my name. I have not got a knighthood, right, that you have to call me sir. But, nevertheless, good evening, everyone. Thanks, GIBS students, GIBS Management Committee, for giving this opportunity to speak in front of you. You guys are a bright group of students. This is thanks for the opportunity to, have me speak here on the topic. Uh, so the topic that, I'm gonna talk about is not only relevant, but also crucial, for our shared future, right? And the topic is how finance professionals can help fight climate change, right? So, uh, you know, does it look relatable? It does not look relatable. Uh, but really, finance can play a big role in kind of fighting climate change, or I would say we can't reverse the damage that has been done, but at least we can help in reducing the damage to a lot extent and achieve the targets, right? So I'll talk about, just to give you a brief background. I'm sure, all of you are aware of the long-term impacts that the climate change has done to us, right? Um, so just to give you a perspective, do you guys know what is PPM? Have you ever heard PPM? Anyone? Yeah, correct. So what is, okay, now that you know what is the unit, can you let me know what is parts per million? What is measured out of parts per million? Anyone? Okay. So parts per million is the unit of measure of carbon dioxide in or carbon in the environment. Okay. Uh, yeah. So, what does 418 ppm means? So, currently in the environment levels, the carbon footprint is 418 parts per million. Okay. Now, does this mean anything to us? Maybe yes, maybe no, right? But just to simplify it, I'll give you a perspective. Industrialization started, I would say coal-based industrialization, right? Started sometime around, late 19th century. So around 130, 140 years back. As per scientists, the ppm count was 300 in the environment. So from within the, in the last 130, 140 years, 300 ppm has gone up to 418 ppm. Now, does it say a lot of things to you? Maybe yes, maybe no, right? I'll give you a slightly larger perspective around this. Scientists have also done a study of all the fossils that they have collected, all the information that they have about the world. They're saying 10,000 years ago, the ppm count in the environment was 200. Now put this in perspective. It took 9,900 years for the world to move from 200 to 300 ppm. In the last 130 years, we have moved from 300 to 418, right? So that says a lot, right? Now you can put the larger perspective, how for increasing 100 ppm it took 9,900 years, and in 100 years we have raised it from 300 to 418. Now, this happened because there were a lot of advancement also that has happened, right? Humankind has not seen this level of progress. When I say progress, it's real progress as well as, non-real progress. In the last 130 years that we have not seen in the world, right? And the world cannot adapt to such a rapid change. Now, what are these changes? Rapid deforestation, right? Increase in temperature, right? So, yeah. So, what does this mean, right? And you would have heard a lot of these stories around glaciers melting down. I'm sure a lot of you have read through that Maldives will be underwater in the next 30, 40 years. A lot of islands in Philippines will not be present. A lot of Indonesian islands are under risk. Even our Lakshadweep is, under severe risk of going underwater, right? So that is all because of the, rise in carbon as, which leads to rise in temperature, right? So currently, between pre-industrialization, which is the last 130, 140 years, the temperature of the world currently has increased by 1.1 degrees, okay? The scientists have taken a target that the temperature rise can't go beyond 1.5. So currently we are at 1.1. 1.5 is the threshold that we have agreed as a world or as one community. And you would have heard about COP, right? Climate summit. So there, most of the Western worlds have agreed to a climate target date of 2050. So every country, who is a part of COP has agreed that they will become net zero by 2050. By 2030, all the major economies in the world, including US, has agreed to reduce their carbon footprint by 50%. Okay, India, and realistically so, because we have been an oppressor of the industrial revolution which happened in the West, we have negotiated and we are saying that now that we are trying to grow, you can't be putting us, as a, under the scrutiny of carbon credits, right? So we have got a target of 2070. So you would see in this year's budget, right? If you guys, I'm sure all of you finance folks have followed the budget. In this year's budget, we have started promoting having solar panels in our terrace, right? This is a start. A lot more activities. I don't know if any one of you have followed the Karnataka budget today. Even our CM here is talking about solar lighting across the villages, right? So these are the steps that you would see governments taking as well as organizations. The organization where I work for, Wipro, we have agreed to a 2050 net zero target. We have planned to reduce our footprint by 55% by 2030. We are already a part of Dow Jones Sustainability Index. We have ranked #1 in the last, I think, 10 or 12 years, right? So as an organization, but our organization is just a very small part. We have to work as a community. It will not work only based on, one organization or twice, right? So, I wanted to set a baseline of the climate problem and, where we are. Now, as finance professionals, what is the future looking like, right? So how do you measure progress? I'm sure, we all agree that the progress is huge. I grew up as a 90s kid, right? I have seen a stage where, in my home, there used to be landline phones. After that, mobile came up, and nowadays, we don't even watch TVs, right? TVs have become a thing of the past, apart from, indulging in some Netflix movies or stuff. It has not become a regular stuff anymore. So we have seen a lot of change. But has this progress come without a cost? This progress has come by a lot of underreporting. Now, as finance guys, when I say, underreporting, what does this mean? This means that we have not accounted for the impact to environment for our businesses for all this while long. And we are not even doing it today, okay, to give you a perspective. And with all these changes happening, right, we all have to look at how to record or how to, account for the impact to environment has to happen. And for that, there is a criteria. I'm sure a lot of you would have heard about it. It's called ESG, right? So anybody, wants to know what is ESG? What is E stands for in ESG? Sorry? Environment. Very correct. What does S stands for? Social. What does G stands for? Governance, right? So do you guys have this subject as a part of your curriculum? Is it there? As a part of your ESG, is there a chapter around ESG? Okay. So, see, we spoke about environment, right? What are the social obligations? You hear a lot about diversity. You hear a lot about community recruitments, right? You would see a lot of global companies hiring locally, right? For example, if a US, organization is set up in Bangalore, they would not send people from US. Though it sounds odd because US is a developed country, maybe there would not be a lot of interest of, US citizens to come to India to work. But that's, a part of the community or the social part of it, right? There are multiple other tenets that you can read on. Because of the paucity of time, I'm not going in there. And there is governance also, right? What is your mode of governance? These things all cumulatively form the ESG structure. Now, what is most important is the accountability part of it, right? You would have, I don't know, how many of you have heard about impact accounting? Anyone? Okay. So let me give you an example. So I made a small statement, right? Say, what I told was that there has been a lot of progress in the world, but without sustainability. Is it a sustainable growth or not is what the question is, and everybody acknowledges the way we have grown, it has not been sustainable. Now, look at it from an investor standpoint. For example, let's say you want to buy 4 commercial buildings, right, as a part of your investment strategy. Now, you look at, what is the real estate market rate, what kind of rental yield that you will get out of, what are the expenses. So you will make a P&L out of it, right? What could be my revenues, what could be my cost. But when you talk about cost, are you factoring the cost of deforestation? Because you would have cut some trees to build that building, right? Are you taking care of all the electricity that you're using? Those coal-based electricity, or it's a hydropower-based electricity, or is it a nuclear power electricity, right? So if it is coal-based, then you are using a lot more carbon, right? Or you are releasing a lot more carbon by using the electricity which is coal-based. So these costs, when you look at the P&Ls or in the balance sheet, right, as a as a contingent liability, you will not find neither of these components in the balance sheet or in the P&L, which means we have been under-reporting for a very long time, right? I'll give you another example, or maybe 2-3 examples to make it much more easy to understand. How many of you have heard of a company called as Exxon Mobil, to make it a bit more relevant? So it's one of the largest, you can sense it as a competition of Shell, right, in the global market. So Exxon is one of the largest US oil and gas company. If you look at their annual report, and I would urge you, next time when you read, right, read their annual report, they disclose the amount of carbon emissions that they do, right? They have started disclosing it, not that they used to disclose. But if you look at 2022 annual report, they have disclosed that there were 730 million ppm, right, has been released in the environment by Exxon. Now, what is the cost of it? If you look at various studies, right, the cost of carbon emission ranges, per ton, sorry, not million, per ton, ranges between $50 to $200. If you look at the latest Biden administration guidance about how they are measuring their carbon credits, it's around $50. Now, 720 tons multiplied with $50 turns out to be around $35 billion, right? So in a year, $35 billion worth of impact to the environment has been caused by Exxon. Now, if you look at their P&L, you would not see that cost, right? But if you look at their P&L, they have made a profit, in calendar year 2020, somewhere around $32 billion, right? Now, if I adjust the $35 billion of carbon emissions, would Exxon be a profitable company? The answer is no, right? Similarly for Toyota, if you look at Toyota's financials, and they also disclose their carbon emissions to the environment, they will not be profitable. Now, what are we doing here? By underreport, now this is what I called as underreporting, because that cost is not appearing anywhere, right? So if you look at, if a company is making money, where are they putting that additional profit in? Exxon is trying to find more oil. Some other company, or Toyota is manufacturing more IC engines, right? Imagine if this reporting would have started 50 years back. Toyota would have mastered the art of EV by now. They would have made, we would have been driving hydrogen-powered, cars. We would be flying electric flights, right? But just because we were so comfortable looking at our profits, because we were not reporting the costs, that we are causing to the environment, we were feeling happy about it, right? So in the future, this is going to change. And that's where ESG and impact accounting is going to come, right? So as you guys who will be the future finance professionals, right, it's very important for you to understand this nuance. I, for a fact, believe 20 years from now, the CFO of any organization can't be a CFO if that person is not fully aware of the ESG accounting guidelines. Those guidelines are still getting developed, IFRS is still working on a lot of guidelines. IPCC is, helping. There is a organization called as GRI, who are setting up these guidelines of carbon credits, carbon offsets, and all these stuffs, right? So if you start pivoting around ESG right now, I think this is a good time for you to understand, and you will do a better good to the society, because, as finance professionals, that is the flavor, today, which is, I would say, is missing, right? And that will come sooner or later, because of all the targets that, as a country we have taken as 2070, as a world we have taken as 2050, right? So that's about, impact accounting. Now, what all different instruments can we do, right? For example, how many of you have heard about BlackRock? Okay. So BlackRock is the largest, asset management company, right, in the world. I think they manage assets somewhere around 20 trillion. So if you look at BlackRock's ESG disclosures, right, you would see BlackRock has changed a lot of its investments into, green investment, right? So they have created portfolios under their as a AUM, portfolio, where they have created a lot of, I would say units, right? Or, I would say mutual fund units or hedge fund units, which are ESG driven, right? So there is a positive change. If you look at Unilever, right, they are disclosing their carbon emissions, right? There's a strong culture going on where every company is disclosing their carbon emissions. Now, if you look at the carbon emissions disclosure data and multiply it with $50, which I told you, is the current US administration ascertained cost per ton of carbon released in the environment, it comes to $7.8 trillion, right? So imagine in the Western world, only by accounting for carbon offsets, it's 7.8 trillion. Now 7.8 trillion is 2 times India's GDP. It's 1.5 times UK and France combined GDP. It's almost 35% of US GDP. So that is the level of impact only in the Western world, right? If you add China, if you add India, that number can go anywhere around, maybe 12 to 13 trillion dollars, right? So a lot of new instruments has to come up, right? I don't know how many of you have, anyone of you have heard about green bonds? Okay. So, good. So this is, something which is issued by World Bank, right? Instrumentally, the first project which was financed by green bond was, I am forgetting the name, but any hydro power facility in Himachal Pradesh in India. That was the first project that was, financed by Green Hub. So, these are the initiatives as finance professionals, right? Tomorrow for the future, you guys will have to create these innovative financial instruments, which will promote a lot more investment into green companies, right? There is something called as credit offset, right? So whatever carbon that you put in the environment, you can buy credit offset so that your net accounting, right, from a, concept of carbon exposure is net zero. So that is the concept of net zero. Now, what is carbon offsetting? Carbon offsetting is, for example, let's take an example of Suzlon, right? It's a wind energy company. Now, if Suzlon is 100%, or let's take any plant-based food organization, which is completely organic, right? So let's say they are not spending any carbon, or they are not releasing any carbon back to the environment. So they have a lot of credits, which you can buy, and let's say an Exxon, right, can buy carbon credits from a plant-based food company. So what will happen, a lot of money, excess money, or the profits from these organizations, large organizations, will be flowing into the, green organizations. And that's how the ecosystem can get created, right? And these are happening only through accounting. Imagine the power of accounting, that can drive behavior, right? So that is around the, impact accounting part. Sorry, can you just move to the next slide? Yeah. So what are the role of financial institutions? We talked about the green bonds, right? All of the banks, right? They can take a proactive step of kind of financing, not only banks, it has to be driven by the governments, right? Where green companies will have a separate incentives, right? There has to be an incentive scheme where anybody who is into credit offsets, those kind of companies are getting promoted. When this accounting, logics come into, full fledged from an disclosure standpoint. So these are the larger schemes I feel, in the future that will come up for finance individuals. Future CFOs will have to know ESGs, the impact accounting. So if you start having a knack around these, topics, it will surely make you way more resilient to the upcoming changes that will come in the finance, community. Now, to conclude, right, what I would say is that, see, when we talk about climate change, we always talk about climate activists, right? Not necessarily, right? Though we feel that, they are the people who are only talking about the climate change, but even finance professionals can be the architects of a sustainable future, sustainable climate change. And only through, briefly we spoke about these four different, ESG, impact accounting, role of new financial instruments, a lot of technology can be used, about these. And if you look at from future standpoint, right, we have to make sure that our 418 ppm does not go to 518 in the next 50-60 years, right? So we have to restrict the temperature rise, and that's where finance professional can be the climate heroes, right? And I feel apart from technologies, the biggest contribution to the climate change will be the next generation finance professionals, right? So that's how I would like to conclude my talks around this. Any questions? I'm kind of happy to take. Am I in time? Timing? Is it? It's okay. Any questions from anyone? No questions? Okay. Thanks everyone, and thanks again for the opportunity.